Okay, ladies. Hey, my favorite girls.
Hey.
Hey, everybody. We are queens of the DMV here to talk real talk and real estate with Arial Pegues and Cher Castillo. Today, we are going to be talking about avoiding these tax nightmares. This is really near and dear to me because I've had a lot of mistakes in that area. So I just felt we all felt that this was a hot topic, especially now for tax season. Dealing with realtors, dealing with just personal taxes, anything, this is really a good topic today. So we have on joining us today is Amani Ahmed. She is a CPA. Hi, there she is.
Hello, ladies.
Welcome.
Thank you.
Yes.
Thank you. Glad to be here.
Absolutely amazing. She has gotten me together. And it wasn't easy. I think it probably took maybe about 3 years for me to get in line. But without any introduction, I just want to, if you could tell everybody about yourself.
Well, thank you again for having me, the Queens of the DMV. My name is Amani Ahmed. I am a practicing CPA right outside of Washington, D.C. My office is located in Lanham, Maryland. I've actually been practicing. I'm going into my 24th tax season, believe it or not.
Wow.
Yeah. So I've had my own practice going on 14 years now, and I primarily work with small business owners, self-employed professionals, and real estate investors, real estate brokers, and realtors. And what we do is tax preparation, tax resolution services, which means that if someone owes a lot of money to IRS or state, typically our cases that we represent is where they owe at least $50,000 or more. We step in and represent them or, help them resolve their case, whether doing an offer to settle the debt or get on some formal payment plan. We also do small business accounting and consulting. And lastly, we do business incorporations. So glad to be here.
And where can people find you on social media?
So my firm is called AGA Second Word Group. So I'm sure if you Google AGA Group taxes, it'll probably come up on Google. But on Instagram, it's at my name, Amani S. Ahmed, CPA. And hopefully we'll have a tag of my title where they can see the full name of Amani S. Ahmed. And on Facebook, the tag is Maryland CPA. And I'm not a big social media butterfly, so literally just started my IG account a couple of weeks ago. So I apologize for being a newbie to that, but
it's okay. We know you're busy.
Yeah, thank you.
Definitely. So we're going to get into some questions for you today. My very first question as a realtor, what are some common things of setting up the right tax structure for your business?
Okay, so really that's a really good question, and there could be different types of answers. I always tell any self-employed professional or business owner that you want to know where you're at with your business. So some people are trying to tax plan when they're just starting out as a realtor. So I use the analogy of they're trying to graduate from high school, but they haven't even gone to the first grade yet. Mm-hmm. So you have to know where your business is, where's your priorities lie. So when you're first starting out as a realtor, it may not be that you have a lot of disposable income or net business income. So in that case, you can continue to build your business as a sole proprietor without actually setting up any formal incorporation. Now, as you begin to increase that net income, then you are starting to look at a business structure that is tax advantageous. Many people go to LLC naturally because what they're told or what they read online. And I won't go too deep into this because these are the conversations I try to have with clients. But just know when you get an LLC, people think that, oh, it's legal protection. Actually, it's not. By definition, an LLC, limited liability company, requires that you have, at a minimum, a managing member, which means they have unlimited exposure. And unfortunately, most people go out and set up an LLC. They're the sole owners, and they think they have limited liability coverage, but they're considered the managing member unless you have, more than one person or more than one owners, because it can be a business as well as an individual to own the LLC. So generally with my clients, we look at a S corporation, a small corporation, because they, that does provide the biggest tax and advantages in terms of paying the least amount of tax, but still be able to get all the benefits of, the deductions that are allowed to you as a realtor. And I'll also say that with S corporation or any type of separate business tax filing, as a S corporation requires, the rate of audit is much lower. So anybody filing the Schedule C that's either a sole proprietor, meaning they don't have a business incorporated, or they do have an LLC and they're the sole member of that LLC, then they're going to file a Schedule C as part of their 1040. Well, the rate of audit is 10%, and that's pre-COVID. Now IRS is going to have to make up this money of all with the stimulus payments and all of that. So generally speaking, they rev up examination, and IRS just put out there that they're looking to hire in the auditing department.
Wow.
So I do anticipate that 10% to go up to about 15 or 16%. So that's the second main reason why I kind of steer clients to looking at incorporating as an SCorp.
Okay.
Interesting.
Yeah.
Is there a major difference between specifically, because I know most realtors are LLCs. What would you say the major difference between an SCorp and benefit-wise versus an LLC is?
Yeah, so with an LLC, because of the way you file, IRS considers a single member LLC considers it as a DRE, which means disregarded entity. So with a disregarded entity, the LLC collapses into the taxpayer. So meaning that it's only one filing, which is your 1040, and you're filing a Schedule C with that. With any net income from your business from the LLC, it's subject to what's called self-employment tax. So if you look at if you look at your 1040, all of the forms, you're likely outside of the Schedule C, or in addition to the Schedule C, you'll have a form called Schedule SE, which is self-employment. And that self-employment tax is at a rate of 15.3%. So that tax is in addition to regular income taxes that you pay. So if, for example, let's say that as a realtor, you made $150,000 through your LLC, you report $150,000 in terms of gross commissions, your expenses was about $50,000. The net income is now $100,000. Well, that flows to the Schedule SE and calculates at a rate of 15.3%, $15,300 just in SC taxes. And your effective tax bracket could be about 20%. So you add the regular income tax of $20,000 plus the self-employment tax, that comes to $35,300 just on a net income of $100,000. And we're not even talking about state at a possible additional 5 to 8%. So if we compare that to an S corporation has its own filing. It does not pay its own taxes. The income does flow to what is called the shareholder. So you having that LLC, actually LLCs can be converted to SCorps.
Mm-hmm.
So being treated as an SCorp, you are the sole shareholder. So 100% of our example, that net income of 100,000 would still flow to your 1040, but it's the way that it shows up on the tax return. There's no more Schedule C. It comes on page 2 of the Schedule E as just a net number, 100,000, and then the self-employment tax is 0. So you go from $15,300 tax bill on SC, self-employment tax as a Schedule C filer because you having an LLC, to if you are an S Corp, same net income, but it's 0, saving you that $15,300.
So really, you're only paying the 20% versus the 35%.
Correct. So you
so basically, I need to get off the show right now and go change my
right.
Wow, that's really good information, though. I didn't know that. I mean, that's like a major savings.
Huge savings. Yeah.
And what's the process? I mean, is it a difficult process to change from an LLC to an S?
It is. And the only reason why I say you can actually Google it and you can download the forms, but unfortunately, you are required to request from the Department of the Treasury, request election as a S corporation in the year that you incorporate, which many people don't know. You can actually do a late filing election, but there's certain verbiage and an explanation for doing the late filing. So we use statutes like codes that are exceptions to the rules to do the conversion. So that's why it does make it hard if you were attempting to do it on your own. So I would say definitely seek out a professional to do a conversion. But if you're doing an initial incorporation, you may want to consider an S Corp versus an LLC.
Right.
Good, great info.
Thank you.
So I was going through what are some common mistakes that a business owner makes? I would say realtor, but I want to talk business owners, realtors, period.
Yeah, I mean, I don't mind staying on the subject of realtors. I think, as realtors, the focus is on quota, right? How many, leads did you generate? How many people did you call? How many people did you follow up with? And that becomes your world in terms of what consume you as far as numbers. And then you got this other component in terms of uncertainty. You may close and receive commissions 1 month and not for another 6 weeks or 8 weeks. So finances is always a bit tricky or kind of like a roller coaster. So it's like, how do you create sanity in this world of uncertainty? So realtors have that challenge to get to a place where they can, have some type of tax protocol as far as putting taxes aside, irregardless of how uncertain the next time that they're going to get paid. So the first primary issue is that how do you create sanity, or how do you create protocols, financial protocols, in a place of when you're working in a world of uncertainty? And for me, I just tell clients, you do the best you can, but you do want to set aside a certain amount of taxes. And that goes into my second thing, is being in a position to outsmart your poor money habits. So
I love her.
I can't do it.
So becoming a realtor does not, negate the fact that if you didn't really know how to manage money before, it kind of exposes you, right? Because that's a habit that hadn't necessarily been put in check when you started your career as a real estate professional. So you really got to be in a position to be open to changing that, because people that end up owing taxes and being assessed penalties and late fees, it's not something that happened overnight. If you look at the history of how they handled money, it's a good indicator in terms of how they're going to handle taxes. So if I can get clients in a place that they feel comfortable and understanding their obligation from a tax standpoint, then it makes it easier for them to be willing to outsmart their money habits. And I think you got to go a little further as realtors. Yes, it's great that you love being able to help people purchase their home or sell their home, but you're also in it to make a profit. You're in it to make money. I can't honestly sit here and say, yes, I love numbers so much that I'm not in it to make a profit. So if that's the case, you have to make every dollar you make bankable or make it count. So educating yourself about taxes, that would probably be the third thing I would say that could be lacking in terms of awareness when it comes to this area, is that realtors really willing to go beyond. Okay, I understand there's the requirement or the need or obligation to focus on my numbers to build sales, but there is just an equally importance of me. Sorry, I'm just a screen popped up, so I lost your beautiful faces. Um, there's just an equal importance to understand numbers from the standpoint of what I report in net income and why am I paying the taxes that I pay. And then lastly, getting into a place that you are compliant. I think the biggest expense to realtors are these unnecessary fees of paying late fees and penalties. IRS charges up to 25%. Some states go up to as much as high as 50%. So if you're willing to outsmart those poor money habits, you can save yourself ultimately thousands of dollars that goes to these government agencies, and where you could be keeping that money in your pocket.
That's good information. So while we're talking about write-offs and things of that nature, what write-offs can you tell us about for everyday people in regards to buying a home? Like what things can people write off when they're buying a home?
So are you meaning like your clients purchasing a home or realtors? Can you give me some more context to that question?
So let's say we have a client who's purchasing a home, or maybe it's their first or second home or vacation home, something of that nature. Like what advice can you give as far as write-offs that they would have? And then also a twofold question. What are some write-offs for people who are self-employed?
Okay. So for the first question, when a homeowner purchases a home, the typical type of expenses they can deduct is the mortgage interest that's on the loan. If they're subject to what is called PMI, mortgage insurance expense, they can deduct that, as well as the real estate taxes that they pay on the property that they purchased. When they initially purchased a home, they may have paid, if they were subject or they pay points or loan fees, those can be deducted. And sometimes on your HUD-1 or closing disclosures, there could be prepaids of property taxes that could be also deducted that would not necessarily be reflected on the year-end mortgage interest statement. So the year-end mortgage interest statement is something that you receive after the year that you purchase your home. Like when you get your W-2s, you get a form 1098. And that 1098 just specifically states how much mortgage interest and real estate taxes you paid, along with any PMI. The only issue with that is that in that initial year after that initial year you purchase it, it may not have the points on there. It may not even have the prepaids. So generally you would want to take not only that 1098, but your closing disclosure statement to your CPA or accountant to ensure these additional deductions are taken as part of the first year. The second question, typical types of deduction for self-employed professionals are, if you tracking your mileage, so to the extent that you have business miles, and vehicles. So you have two types of auto expenses that you can deduct. You have your normal day-to-day maintenance and operations, so fuel, repairs, oil change, car washes, and so forth. And then you have your ownership expenses. So the cost of the vehicle, or if you're leasing it, or if you're renting it. So with the first type of auto expenses, you can either take what is called business mileage, typically at a rate of 54.5%, and it differs per tax year due to inflation and where we're at. And or the actual expenses for your fuel, for your repairs, for maintenance, changing tires, and all of that good stuff. The second type of expense people don't generally take is the ownership of the vehicle. So if you have a vehicle that you're primarily using for business, and when I say primarily, means over 90%. So IRS has a code that says to the extent that you use your vehicle 90% or more, the rest of that 100% is considered de minimis. So meaning that you can take 100% of the total vehicle expense, ownership expense, as a business deduction. So what does that mean? That means you get to what we say it's a fixed asset, and we get to depreciate that. So we can take it over 5 years, the cost of that particular vehicle. You don't have to be in a situation where you own you're using the vehicle 90% or more to depreciate it. It could just be whatever that percentage is looking at your mileage. So if you drove, 10,000 miles for the year and 40,000 miles was attributable to your business, then you can write off 40% of the cost of the vehicle. So that's one popular form of expense. And any other direct expenses that you would pay. So if you're paying any dues such as M-Car, PG Car, Central Lock, any type of these fees and advertisement fees, if you're advertising online or different types of platform, any type of direct fees that you incur that to promote you as a realtor, you get to deduct. Any continuing education. So I know different brokerages have where they'll have a conference and have their realtors and brokers come out, and they may charge a conference fee, and then you have your cost with traveling there, the travel and lodging. Those expenses would be deductible. The one type of expense in that, as well as your day-to-day operation, that may not be deductible is your meals and entertainment. Or should I say meals, because entertainment went away in 2017. So the meals that you pay, if you're just at your office all day, or your home office, or you're on travel and you're purchasing a meal at the airport, or in between conference sessions, those are not considered deductible. The type of meals that are deductible are the ones that you have perhaps with a fellow colleague or prospect. And those you can deduct. With 2020, with all that has taken place with the pandemic, there has been an exclusion to allow 100% deductibility of meals. Prior to 2020, it was limited to 50% deduction of your total meals.
Oh, wow.
So we could have been deducting our happy hours, y'all.
Exactly.
Liquor is not. I'm glad you mentioned that, Ariel. So liquor is not deductible.
Ooh.
So we would have to exclude liquor.
We definitely eat too.
Yeah.
But definitely the food. Yeah.
But non-alcoholic beverages are okay?
Oh, yeah.
Regular beverages, absolutely.
So I didn't drink last year then.
See?
So all of that could be deducted, Cher. So
do we need to really keep all of our receipts?
So obviously, if I was an IRS agent, I would say yes, all of your receipts. But the truth of the matter is, if you have majority of your receipts, it's okay. But I think more importantly, it's not the fact of trying to keep track of your receipt versus having a process of tracking them. So with our clients and even in-house, we try to adopt a paperless environment, meaning that everyone has scanners at their desk, and we encourage our clients to do the same. Get in the habit, 10 minutes a week, almost maybe an hour a month, where you're scanning all of your receipts into some kind of cloud, iCloud, Dropbox, what have you. And you do it by year. So you'll have like 2021, January, at the end of January, you go through and scan in through all your receipts and you just save that file to your January folder and you just continue that on throughout the year. That is the number one tax saver. I mean, just spending those 10 or 15 minutes will save you tremendously. I'm currently representing a business owner who has a tax bill of $403,000. Not that he just frivolously just put expenses on his return and all of that and didn't report income. It's just that he doesn't have the receipts to document it. So if he just took that 10 minutes to just upload them to a folder online, I would say all but 40,000 of that $403,000 would have been would have not have been assessed. So setting up an online or cloud accounting system folder, and you want to also upload your bank statements and credit card statements, any statements that you use to do transactions. So this is one of those things that it is tedious, but I call it audit proofing your business. It is so worth it at the long run if you were ever to get audited.
I've actually just recently in the last 6 months subscribed to software specifically for real estate called Realtizam. And I don't know if you're familiar with it, but it's actually saved my life. Like literally I've linked it to all my credit card, debit cards, all of that. And it just pulls in the data. I create the subcategories and every month I just kind of go through. Some it does automatically, but then some I have to go in there and do. And my accountant was like, what's changed in your life? You're so organized right now. I'm like, no, this is really cool software that just makes it easier because like QuickBooks and stuff, that's over my head. It gets way too complicated and then I just give up. But this is super user friendly. And then I can download all that information and send it to my accountant quarterly or monthly. And it just makes things so much easier. So it takes out that having to upload portion because typically I'm just moving too fast to like scan or something. So since it's just auto pulling, I find that to be so helpful for me.
Well, and I'm glad you brought that up, Cher, because that's wonderful because it sounds like you have an accounting software that's extracting the income and expense activity to perhaps provide a statement of the net income and net loss in those specific kind of categories. That's huge, being able to sync that in where it saves it. But the added step is those actual receipts, right? Like the receipts where you get from the store, which typically it's hard to sync those up because you're syncing the bank accounts or the credit card account to an accounting software such as Realtizam, which sounds like a phenomenal accounting product. But there would still need to be that added process to do those receipts, because the thing is, when IRS, if an examiner looks to audit, they're looking at three things. They're looking at a compilation of what a accounting software such as that or Intuit would do, a profit and loss statement. They're then looking at the statements that back up those totals. Okay, you said you had total cell phone $2,000. Okay, we can document that with your 12 months of bank statements, of those expenses being shown. But then they want the third piece, which is the actual bills, the bills and invoices and receipts to that. And most business owners, they may not have number 2 and 3, but definitely number 3, those receipts and invoices is what get businesses in trouble. You think that, yeah, I have my activity synced with my bank account and all of that. Why don't you, this should suffice. But in IRS's eyes or any tax agency's eyes is that just because it says Staples on your business account or business credit card, how do we know that you actually purchased something for the business? And you got some really wacky, I know it's beyond the scope of this call, but you have some really wacky IRS examiners. I actually had one tell me my client purchased with his receipt a luggage bag. He's a railroad person, and he travels like throughout the nation. And it's like a computer bag luggage. And it was 40 some bucks. And this examiner was trying to tell me, well, we think that's personal. Like, who is going to be taking their computer for personal reasons, traveling for business? So there be some interesting arguments with auditors. So the cleaner that you make it, the more that you preserve documentation, the better it is for you.
Awesome information. I saw Cher taking notes. I know that's
I was ready to remember this.
And I'm talking because I've made this mistake with commingling personal and business funds together.
Yeah.
So because Armani, you set me straight about that. I still mess up, not gonna lie. But I'm getting there, that I'm learning to, separate the two. The personal and the business accounts needs to be separate,
Yeah, so I always can attribute it to this thought or this idea, we tend to do what's easy versus what's right. Mm-hmm. So it's just easy for us to just, swipe the, business card because that has all the money in it, pay our personal bills out of it versus doing what's right and separating the two types of activity. So one will need to realize the importance of that. Because it's less scrutiny at the end of the day. And it's just easier accounting when you can have one specific bank account and one credit card or credit business cards separated from personal cards. It just makes it easier. But if you do have an S corporation, you are required to have a separate business account. If you have an LLC or you're a sole proprietor, technically you can commingle, which is not encouraged, but you can also have a separate personal bank account that you're doing the business transaction out of, and you have another personal account that you're doing the actual personal activity. So that second account where you're doing the business activity, it can be in the LLC name or it can be in your personal name. But as long as the nature of those transactions are related to business. And I know everybody has a hard time kind of trying to pull those, apart and respecting one account for the other. It's just, once again, with the receipts and invoices doing the tedious thing of scanning them ever so often. This just creates much more clarity in terms of making it easier for you to account. So yes, you do want to set up that separate account and then, slowly get to a place where you're having all of your personal taken out of the personal account. Mm-hmm. Granted, your commission checks will be going into your business account. Right. You can actually, to get money out, you can, withdraw it like an ATM or, a withdrawal from the teller, or you can do a transfer to your personal account. The impact of that, generally, it's not taxable because it went from your business account to your personal. It's generally considered an owner's draw anyway. Mm-hmm. So whatever your bills are for the month or biweekly or weekly, you just transfer that amount to your personal account and pay those expenses from there.
I like that. So what do you, okay, so, we talk about life after real estate and setting ourselves up for retirement.
Mm-hmm.
So, what would you say about that? What is the plan, or what should we do?
Yeah, so Arnita already knows that I'm not the typical, CPA to say, go get a tax deferred, plan, because the way that we do taxes, and if I could tell a little bit about your business, Arnita, not specific numbers, but percentages. So Arnita and I met looked at her year-end numbers, and we determined how much taxes she owed. And Arnita, initial, as everyone else's, that is a lot, Amani.
Okay.
It's never small enough, right? So I was like, no problem. I said, so we looked at the amount of taxes compared to the ratio of her gross income, and it was at a rate of 5.89%. So when it comes to, with at least with my clients, my two focus is this: how much cash can my client keep? And how much can we reduce their taxes? We're not trying to evade. We don't want them to overpay taxes. You must pay taxes, but not to overpay. So once we're at a place at 5.8%, we're in the single digits in terms of effective federal tax rate. Then for me, I'm not going to advise Arnita to go set up a tax deferred account where, yes, she gets to, let's say she put $10,000 away, she's saving 6%, $600 on that $10,000. And then when she goes to retire, house is paid off, kids are grown, she has really no write-offs. So she's going to be at least in a 25 or 26 income tax bracket. Mm-hmm. It makes no sense for me to have her go from to avoid paying 6% today to turn around and pay 26% when she retires. So naturally, because we are in a capitalistic society, it makes money to, create types of accounts and get them funded and stuff without stepping back and being strategic about it and saying, okay, what does it cost me today versus what it will cost me tomorrow? In some cases, some of my clients that are like doctors and therapists, they are at a high, amount in terms of effective tax rate. So for them to put it in a tax deferred product, it does make much more sense. Mm-hmm. So going back to Arnita's original question, I would say not only I would say, yes, you can consider the tax deferred products such as a Roth IRA, a traditional IRA, but you want to look more so at non-tax deferred products. I love Roth IRAs. You can actually set up a Roth 401k Roth IRA, a 401k that is based on a Roth. So you're putting up to $19,500 in a Roth, which is a non-tax deferred. So meaning you don't get the deduction of that amount today, but so you pay money on the seed, you don't pay money on the harvest. Okay. So once you go to retire, that $19,500 ends up being $40,000. You already paid taxes on the $19,500. So you got $40,000, so another $20,000 tax free. So that would be the primary place I would put money in. And I'm a proponent of life insurance policies because if you know anything about it, you know that it's nothing but a conservative savings plan. Right. So you think of life insurance, you're thinking of beneficiaries after I leave. But there's a really good book, and I'll give you guys the link when I get a chance to. It's by, I think, somebody Nash. It's a Black book called Being Your Own Bank or Becoming Your Own Bank. I read that about 12 years ago and completely shifted my understanding and perspective about looking at life insurance as something for beneficiaries to an actual investment retirement tool. So that is, for me personally, that's my primary investment tool for retirement. So I would share that to be one outside of the Roth. And then the third is, your market products such as stocks or municipal bonds to put money into that as far as retirement, because you're putting it in and you're not looking to take it out. And it's not as tempting, right? When you're out there buying stocks or you have a financial planner and you have a brokerage account, it's hard to get that money out versus if you're putting it in a savings account for a rainy day, you possibly could do that with those types of investments.
So Amani, I found the book that you were referring to. The title is called Becoming Your Own Banker, and it's by Nelson Nash.
Yes, it's a Black book with red
a lock on the front.
Yes.
Got it.
Perfect. Nelson Hash, you said?
Nelson Nash.
Nash. Okay.
And it looks like there's several editions of the book as well. But I found it online. Perfect.
It's that one you just mentioned. That's the version, at least, that I read 12 years ago. And I'm sure he probably came up with other versions after that.
Well, I'm going to download it to my audio because I listen to books in the car. That's where I spend most of my time.
Exactly. That's our office.
Yeah.
And then last but not least, I know I didn't mention this. I almost feel like it's obvious, but real estate could be a form of retirement, right? Like, you're purchasing, to buy and hold. I have many clients that are retirees that may have retired from, their jobs or the government, and they have like a handful of homes that they rent out, and they generate, that disposable income going into retirement.
Love it.
Drop that knowledge, please. We try to tell people.
Yeah.
So it's great coming from another profession, letting our clients know that they have assets and they have, that disposable income.
Definitely.
Absolutely. If it's leveraged properly, and once again, you do have to have good money management skills to properly build a portfolio of rental properties. But it can be not only a huge asset on your portfolio, but it could be something that you can rely on as disposable income and retirement assets.
Excellent.
Love it. I love it.
I mean, so we literally can have you on for another day, 1 hour.
I would love to.
So we definitely are going to have to bring you on again. I think this month has been a perfect time for you to have us soak up that knowledge when it's tax season. So we definitely are going to have you on again and finish this conversation.
Absolutely. Anytime.
Questions for you.
It'll be the episode where what we did all wrong and we
Look, we all make the mistakes. I mean, even as a tax practitioner, I make mistakes. I mean, we all do it, and we just got to give ourselves a pass. So it's like Maya Angelou said, when we know better, we do better, right?
Yes. That's a good closing.
Well, thank you so much for joining us on our Queens of the DMV show. And as always, to our listeners, thank you for listening, and check us out on Spotify, YouTube, and Apple Podcasts at the Queens of the DMV. Thanks so much for listening, and we'll see you next time.
Thank you.
Thank you for having me. Thank you, everyone.
All right.